In today's video, I'm going to do a top-down analysis on XAUUSD, which is good, and which you already know that in these previous years, which is 2026, there's a whole lot of volume on gold, and which we can see that the highest price for gold currently, which we are seeing at this level, is 5,600 USD. So, which since gold has reached this level of price, the volatility of gold has increased so massively, and which also makes that 0.01 lots has also gained volatility. Right now on gold, if you're trading a 0.01 lot, you must make sure that you have a suitable capital up to $500 or $200 in your trading account before you can be able to trade this pair. Right away, this pair is no more for beginners and is no more for traders that doesn't have capital. Although recently, since I noticed the high volume on gold, I added gold on my list. Really quick on gold, if you notice that there have been a really massive rally to the up, and then we have a pullback. So someone messaged me and told me that I should do this a top-down analysis for SMT, which you guys know. Today's video, I'm going to do a top-down analysis based on SMT. So when I come to the chart, first thing I want to say is to know where the trend is heading to, which already know that the trend is already heading to the upside. Then we get a pullback retracement. So what else are we going to get is once we get our entry from here, the push up. So the first thing I'm going to do is to bring out a tool called Fibonacci. So when you get a Fibonacci to what you want to spot, the swing lows or the swing highs, depending if we are on an uptrend. As you can see, you want to first spot a swing low and then point it to the swing high. So what this tool does is to get you a better price position in the market. So once you get a better price position in the market, which is most of the time when a chart or a particular pair is retracing or pulling back, you get most retracement around 61.8 level, or sometimes they go below 78 or 88, which you can see right away. Good push down to 88.6, giving most buyers a more profitable opportunities to jump in right at these levels. So it's very quite simple. What you need to know is to know when there is a break of structure, when you get a low and then get a break of structure at this low. This is very simple idea trading. You don't really need to complicate your chart with a lot of materials. Just know where your swing low and your swing high is, know when they are pulling back, and know when they are retracing. Even if you didn't catch the setup right away, just know that there is possibility of this price trying to break this high. So what I'm going to do is to mark out the levels which this price retraced. So once you know is that when you are trying to get a pullback, there's what we call liquidity levels, and these liquidity levels comes before the supply or demand zone. So when you're looking for a buy, you get a demand zones levels depending on where the price is trying to reach, is at this level. And then for you to spot a liquidity point is levels which price would like to manipulate, which you can see. Then I'm going to use a dollar sign to show you this is a liquidity sign. So it's very quite simple. It's very quite simple. Get your swing low, know your break of structure, and then wait for your retracement. And then for the current market price right away, we will see that we have this high, which is at here. I have this high at this level. So this high is going to be a new BOX. So So this is going to be a new BOS, and then this is our previous BOS. This is our previous BOS. Okay, right away. So this is our previous BOS, and then this is our current BOX. Then this is our liquidity level, and this is our demand zone. This is a scenario that price normally do, saying if you get an entry at this particular lows and lows, you are very lucky, and all you can do is to hold up till you break this high. That's very simple. So if you didn't catch up setups, what you're going to do is to still go to the lower time frame and look for more entries at this level. Once they pull back at the lower low, you look for sell. So whatever happens in the higher time frame has the probability to also happen in the lower time frame. Whatever happens in the higher time frame has a high probability to also happen in lower time frame, unlike 5 minutes and 15 minutes. And more of the time, if you are looking for more of entries, you go to a 5 minutes time frame. That's why I have most two time frame here, which is the 4 hours and the 5 minutes time frame. So for this, what I'm expecting is for gold to break this high. So once they break this high, they might touch this level and then retrace back again, then continue their leg. It's a very simple analysis. So right away, I'm going to remove this fib so that you can see the chart very clearly. So what I'm expecting on gold is to see a push up to break this high. Then once I get a pushback, you can start getting a momentum for sellers, which sellers will want to sell off, which are the pullbacks which you are seeing, which you know that most of the time gold will always go up annually in percentage, because there's no how the gold market wouldn't want to gain percentage, because there is a lot of buyers and a lot of investors in the market who are willing to invest in this particular pair. So I'm going to head into the 5 minutes time frame to see what the lower time frame is doing right away. So the 5 minutes are for day traders entries. If you're looking for more of entries on the lower time frame, what you do is to head to smaller time frame, but more of the time higher time frame is good in, because there's a lot of noise in the 5 minutes. So let's say you are a day trader. What you always want to do is to, when you go to your 1 minute or your 5 minutes time frame, you still want to find the same structures, which you can see. You want to find this same structure, higher high, higher low, and then the breakout structure, which shows you this is the higher high, then the pullback retracement, and just like what is already happening in higher time frame. So you still, once they finished all this accumulation, you want to still see them break above, retrace and continue. So it's quite that simple. It's not too complicated. All you need to know is to just know where the market is heading. No market structure, no BOX, no liquidity, and know your zones, which is a supply and demand zone. That's the key 4 or 5 things you need. One first thing is to know your structure, which is market structure. Then know your liquidity, know your zones, buy zones or seller zone, which is supply and demand. Then you got to also use your fib to know your point of entry, which is your point of retracement. Know your gap. That's just the 4 things that you need. It's very quite simple, guys. So this is like a top down. Most of the time, if you are trading this kind of pair, you don't want to go to a lower time frame, because higher time frame will give you more clarity than lower time frame. So more looking for this pair is that you won't be looking for more of buys to break the higher, break of structure. So it's quite that simple. It's quite that simple. So make sure you subscribe to this video. Guys. Let's get to 2K subscribers. So if I'm looking for anything on this, I will probably want to look for a buy at this range, since I got this range, which is my current lower time frame BOS. Then I have this as my demand zone, which my buyer zone. So the same thing probably is that the same thing that happened here is going to also happen here once they've already break this BOS, little time frame BOS. So most of time these things happen in lower time frame. So what you want to expect is to also look for a nearby zone or a hidden zone. You mark it out and wait for them. But before you mark it out, you must use your fib to know where the retracement is coming from. So if the retracement is coming from that which is the above, you want to make sure you point out entries from 61.8, then wait for confirmations on lower time frame. That's very simple. Look for entries and then make sure that your stop loss is ×3 from the lows of where you entered. It's quite simple. So when you are trying to place a stop loss, you don't really need to be so fixed on a stop loss. Your stop loss should be based on where you entered. Let's say you entered this trade from here, and then you want to measure it from where you entered to the low. Let's say you entered from there, and then the last low of your entry point is 93. You want to make your 93. You want to do a 93 times 3, which should be giving you 93 times 3 should be giving you, let's say if it's 100, should be giving you 300. So 93 should be giving you about 291. If I'm correct, guys, correct me. Should be giving you 291. If I'm correct me, guys. So that's just it. You do your stop loss ×3 from the point low of where your invalidation is, then you target 1:2 or 1:3. This is how you hold a swing trade on gold. It's quite simple. You don't really need to do 1:15 or 1:30 before you can make money on gold. It's very simple. Just really need to know what you're doing. If you don't really know what you're doing, don't come to this gold market, because they are going to make your money and you lose your capital on it. So see you guys on the next video. Make sure you comment, like and subscribe.